Good afternoon. This is Michael Grifferty, President of the GBSA. Welcome to today's Market Insights webinar, Buy-Side Perspectives of the Middle East and Turkey. We have a terrific set of speakers today who I would like to introduce. First, we have Andrew Mulliner, Head of Global Aggregate Strategies at Janus Henderson Investors. We have Abhishek Kumar, Head of Emerging Market Debt at State Street Global Advisors. Katrina Uzun, an institutional portfolio manager at MFS Investment Management in Boston, and Zaina Risk, executive director and portfolio manager at Arqam Capital here in Dubai. I will now turn it over to our moderator for today, Hitesh Asarpota. Hitesh is managing director and head of loan syndications and DCM at Emirates NBD Capital. Over to you, Hitesh.
Divergence between what was happening in the real economy versus what we saw in the financial markets. We've seen all asset classes perform, from fixed income to equities to commodities, real estate, and even crypto. My first question to Andrew was, in that backdrop, right, how do you see what are the key macro trends that are affecting fixed income at this point in time? And what would be your strategy to navigate the current market when we're, trying to counter the rise of the impact of potentially rising yields?
So good question. I think like the market's forward looking. It's front run a recovery that we're beginning to see come through pretty strongly now in global growth, and we're seeing big pickups in forward looking measures, be it the PMIs, all of which sort of indicate that global growth is going to really roar in H1 of this year. The recovery phase is the macro trend, if you will. We're at that stage of the cycle where both growth and inflation expectations are picking up. Monetary policy is very easy. Fiscal policy is very loose generally. It's not exclusively. It's not completely across the globe, and China is an obvious exception here, and I'll come to that in a moment. But generally, it is an environment which is very positive for risky assets. It's tough for long duration assets. And in some respects, because of the unusual nature of the pandemic and the impact it's had on the global economy, the cliff edge in economic growth we saw last year, what we're going to see probably this year, certainly in the first half, is something similar in shape but inverted in terms of a big positive growth push. So where does that leave you? What does that leave us thinking about? We've generally had a strategy that in this stage of the cycle, you want to be long risk. So you want to be maximizing your exposure to spread assets within the fixed income universe. Duration overall is pretty unattractive, and obviously that's been reflected in what we've seen in the big moves in yields. We have moved a long way now. Spread markets are clearly pricing a lot in, and rates have clearly repriced meaningfully higher, especially in the last month. But the reality is you don't really want to fight that trend at this point particularly aggressively. So we still think that's broadly the right approach to take. In terms of like specific markets that we think look attractive or where we've been invested, we've liked emerging market hard currency debt generally. We thought that's been relatively a bit of a laggard compared to perhaps some of the developed market spread markets. So if you look at emerging market corporate debt versus developed market corporate debt, it's definitely lagged, and that's had a bit of a catch up in the last sort of 6 to 9 months. But that's been an interesting place to be positioned. We generally like high yield globally, we think even local currency, there's certainly been a very positive place to be due to the dollar dynamics that we've seen as well over the last sort of 9 months. And I think that's where perhaps like the sort of classic recovery story begins to end, and where you get into some of the more challenging things. So just very briefly on that side of things, one of the notable features of the pattern of this recovery is the degree to which Asia, and particularly China, has been so far ahead of the rest of the world. So we're clearly seeing very pro-cyclical policies in the US right now, which is likely to result in significant US growth. But in China, we're kind of seeing the opposite. We're seeing much more conservative policies. We've seen a general tightening or pulling back, and certainly the messaging from the authorities there is much less stimulatory. And I think, when we look at things like the China credit impulse, we see that rolling over. Obviously, the PMIs out in the last few days also show just a drop off in the degree of momentum. So I think one of the factors that investors will need to focus on this year will be that switch between Asia-led growth, perhaps back towards more DM-led growth, and what that means for the makeup of both global growth, but also in terms of consumption and services, but also in terms of what it means for things like the dollar, which is obviously of critical importance when we're thinking about things like local currency debt, because the dollar should be weak at this stage of the cycle and has been pretty weak. But it's being that dollar weakness view is being challenged by the fact that US growth right now is looking to be one of the world leaders probably in the next 6 months. And obviously with high yields, the US fixed income markets are going to look increasingly attractive. And indeed, from a hedge perspective, US fixed income is now as attractive as it's looked in the last 5 years. So, there are some nuances here that definitely keep us thinking. And it certainly also means that perhaps the skew of the portfolio, which has been much more towards Asia and China-centric economies improving, perhaps needs to rebalance away from that as well. And then, lastly, given the topic of this conference, commodities have been a big winner. We've seen that in terms of, obviously, they had a very big fall last year, had a massive rise this year, both in terms of supply constraint, but also the big demand shock that's emanated first from China and is broadening out. Clearly, that's been a boon to a lot of economies, and that's been a great place to be. But again, the stories of a super cycle coming in commodity space, I think, need to be taken with a pinch of salt. We're in a very strong cyclical position, but structurally, I think some of the tailwinds for commodities over the last 20 years, particularly in the first 10 years of the last 20 years, they're unlikely to be repeated. China is not going to be the great consumer of commodities that it was before. In fact, the increasing push towards renewable energy and cleaner products generally will be a headwind in the longer term. But right now, the cyclical is very strong, and that means we go back to maintain an approach to risk. You want to minimize your duration, and really think about that rotation away from perhaps Asia-centric growth to sort of broader growth.
Thank you, Andrew. And perhaps a question for Abhishek. You head the emerging market debt at State Street. Andrew spoke on DM, China, and Asia. Where do you think Middle East and Turkey fit in emerging market debt portfolios at this point?
Yeah. So Andrew has covered a lot of ground, and quite interestingly, he touched a few topics. One thing, if you think of this, how have Middle Eastern issues evolved? If you just look at MENA, I'm excluding Turkey for now. 5 years back, they were about less than 3% of the EM hard currency sovereign debt index eligible bonds. So from less than 3%, they have now become almost 22%. They issue 22% of eligible EM hard currency debt. That's a massive leap. If you add Turkey on top of that, Middle East plus Turkey represents the second biggest issuance or weight in the MB index, so not the diversified version. Now that's a massive leap in debt issuance. So it's increasingly these group of issuers are increasingly becoming a big part of our universe. In some cases, or in actually most cases, the IG debt is also part of many global indices. So all the global ag and sub indices also include these debt. So the issuance from these issuers are now being digested by international investors across a range of indices, not just in EM indices. So from being a very small part of our universe, they have become almost the second biggest part of our universe. So they have come a long way. Now, again, most of it is driven by oil. So the question is, the oil where it is and the path of oil, what does it mean for issuers? So except maybe Qatar, where the fiscal break-even is at about oil being at 40, all of the sovereigns still need to issue with oil where it is now. So that leads us to the question of the future of these countries. And as it currently looks like, they are going to be an increasingly part of our universe. Now, the question is, is it sustainable? And that's a question for later, maybe. What do they need to do to be increasingly part of our universe, but not be so big that it becomes a problem?
I mean, absolutely right. We have seen a huge emergence of Middle Eastern debt out there. You're right. A lot of it is driven by oil, and one of the aspects is, besides the sovereign issuers, we haven't seen as many corporates tap into the 144A space, right? Katrina, what are your views? Is there demand there that they can capture FIs and corporates in that space?
Sure. One thing I would just add to keep in mind for the GCC countries and investment grade names within GCC countries in particular is that they tend to be very sensitive to changes in US Treasury market. So they tend to have a beta of the US Treasuries, and on top of that emerging market, that regional risk. Quite a few emerging market asset managers, the buy side, don't hedge the risk of their US Treasury duration, but they just buy and sell what's in the benchmark. And bonds like KSA, Qatar, etc., with their relatively low coupons, relatively longer duration, they tend to be used to buy some of the manager's duration and to substitute for that treasury duration at the overall portfolio level. The other thing to mention is that the Asia and Taiwanese life insurance companies in particular, they tend to be very active in GCC world, and they trade at most when London is closed and Boston is closed, and so that tends to be very noisy. They almost seem to trade from a negative convexity point, meaning they buy when the market is rallying and they sell when the market is sinking. So it's something that it's one of the reasons that we've been careful of adding exposure to GCC, even though it's a large part of the market right now. We certainly do tend to underweight exposure and GCC exposure overall, but it is something that we think about very carefully. In terms of the 144A exposure, yeah, I mean, certainly makes sense to have exposure in 144A from the Middle East countries. And so it's something that, we've seen an increased amount coming up, especially in 144As, but also in Sukuk exposure in general. But the way we see most value in GCC countries right now, and if I would kind of break it down into three big buckets. One is the wealthy three. What you have is Qatar, Kuwait, UAE. We rate internally those countries very similarly. These countries have very similar structural characteristics, very large sovereign wealth funds, have populations that are about 1/3 citizens, and then people with temporary visas, less concerned about unemployment, less concerned about the youth issue there overall. So out of these countries, we like Qatar the most. And in essence, the reason that we like Qatar is that most of their production right now is in LNG. They're expanding it over the last 5 years. It's the largest LNG exporter in the world at this point in time. The crude oil production for them is about 0.6 million barrels per day, whether in LNG is about 4.4 million barrels per day. So really an LNG production country right now. And on top of that, the plans are to expand production by about 50% by 2027. So that is the country that we like out of the overall Middle Eastern region, and those three in particular. I will just say a couple of things on KSA because it's like the second bucket that we look at, and KSA has had pretty big social issues and young growing population, very high unemployment and skill mismatch. About 80 to 90% of the revenues coming from oil. They have increased their VAT tax in April from 5 to 15%, so it's a big increase. They did that in the midst of the pandemic, and they had to really move in that direction, introducing income taxes and other non-oil revenue to lower the fiscal dependence on oil overall. Today, at the oil prices in the mid-50s, we think their debt stabilizing oil price is in the mid-50s. Their the break-even oil price for them is in the mid-60s, we think, and so the financials are a lot more stable with the current oil price. So we have been adding to Saudi exposure overall. And then the last bucket that I will mention is the third bucket of more high yielding kind of countries, and it's Oman and Bahrain. And there, we do like Oman. Oman was the country that until 2019 did very little in terms of reforms, did very little in terms of debt levels. It has a very high debt level. But we do see progress with a new sultan that has introduced a series of reforms that broadens the reform credentials in general within the country, but then on the political front recently created the new position for the crown prince and named his successor to allow more political stability going from here. So that's positive. And on the economic front, he has put forward a medium-term fiscal plan that sets very ambitious fiscal consolidation path for Oman to come. So we've been adding exposure a little bit there.
Thank you, Katrina. Perhaps if I may bring Zena into the conversation at this moment, Zena, what's your view in terms of obviously the recent ballooning in regional debt and budget deficits being high, oil prices being volatile? How are you seeing some of the more lower rated sovereigns in the region navigate this turbulence?
Hi. Yes, basically, I agree. The region has always recently has been reliant mainly on the capital market to fund all these budget deficits, which is why we've seen a significant increase in GCC issuance, mainly driven by the sovereign. Plus, last year we've had not only oil dropping significantly, but we've had the very negative impact on COVID on the overall economies. This year we've seen reversal mainly with a positive rollout of the vaccine, even though it looks like a bit delayed, but still it looks promising for this year, oil stabilizing at higher levels. So overall, we have better fundamental picture for the region. From a high yield perspective, which mainly are the Bahrain and Oman. Oman has done a significant step forward with giving us its Tawazun program, which is a fiscal reform plan. Obviously, the main risk there remains the implementation risk. But at least we have a step forward. Oman managed to tap the market very successfully. And given where markets are now, overall preferring high yield, as my fellow panelists mentioned, high yield over IG, which we also agree with that, which obviously puts these countries at an advantage. This being said, from a valuation perspective, Oman had been the outperformance since November last year. So we don't see much of upside from here, but we still see that it offers some nice pickup versus its IG, versus the IG and versus other EM countries.
Thank you, Katrina. And then perhaps moving on to Turkey, right? And Abhishek, Andrew, Katrina, feel free to give us your thoughts, right? We've obviously seen Turkey as well over the last 3 to 4 months have assets have rallied very significantly. Turkey has been historically very volatile. What are your thoughts on Turkey, and how are you playing that space at the moment?
So I will say that Turkey is one of the countries that ended up with positive growth last year, and that is because of the credit fuel stimulus that they put in. Main problem in Turkey, in our opinion, is that monetary policy is too loose. In November of last year, they started to correct that with a new central bank governor and simplifying the monetary policy framework with more orthodox approach in general. The new governor, addressed the issues by hiking rates. And that will provide them with a positive real rate this year. It's about 2 to 3% because the policy rate is at 17%. The inflation is about 15%. But in April of this year is our expectation. And so they do have a positive real rate there. As the rates go up, deposit rates go up, and locals do tend to switch to Turkish lira when that happens. So monetary policy is starting to tighten with the new central bank governor, and that and that's a positive thing. The one thing that we don't know in Turkey is that how long will it last? Because once growth starts to slow in the first and the second quarter of this year, because these lags in monetary policy tightening will show up in slower credit growth in the country, and it will start to bite. The question is, will Erdogan have the patience, kind of the tolerance for slower growth? That will be a test in April and May when central bank will have to start cutting rates, basically. Our base case right now at MFS is that they will cut in the second part of this year when inflation really starts to move lower. Our base case is that Erdogan is going to view this year as a rebalancing year where you allow economy to adjust in terms of the slower growth and the current account adjustment. Last year, they ended up with 5% current account deficit because monetary policy is too loose, credit growth is too high, and it's one of the very few economies in emerging markets that has actually seen the current account deficit widen in 2019 and 2020. Turkey is different. So it went from the 2.5% current account deficit to 5% current account deficit. This will go into a reverse this year. Growth will start slowing. But current account should see a contraction because of monetary policy tightening. So base case, we think that they will allow for rebalancing because Erdogan does not have the election to fight until 2023. He can allow rebalancing this year, and then the next year he could see some policies or higher credit policies and boosting growth with unconventional policies again.
Abhishek, what are your views on this? More so just to add to what Katrina said as well, I think the higher average oil prices as well will affect them quite a bit. They were beneficiaries of that to a certain extent last year, but we'd love to hear your views on this as well.
Yeah, so Turkey is definitely most of it was already covered, but one thing I do find that they are their issuance has really been quite interesting. So if you think of the way the Turkish banks have been issuing, they have been issuing green bonds. So 4 Turkish banks have issued green bonds lately, which is a very nice way of tapping into an emerging market, especially in Europe. So if you talk to clients, there was a survey recently. If you talk to clients globally, 90% of the clients in Europe or ESG queries are coming from European clients. So literally, you can't step into a meeting in Europe without talking about ESG. And this is one of the markets where many of the issuers are tapping. So it's quite contrary to think about, but actually, I'm surprised that Middle Eastern issuers who rely so much on oil are thinking ahead and thinking about green bond issuances. So for example, Saudi Electric issued 2 green bonds. Obviously, MAF and our first Abu Dhabi bank in UAE have issued along with the 4 Turkish banks. So it's a positive sign. It's still a long way, but definitely signs of improvement. The other thing is, this is what we always talk about, is sustainability of the debt issuance, because just the sheer debt that they have been issuing for example, for the last 6 years, Middle Eastern issuers have been the biggest debt issuers globally in EM space. So, and that's going to continue for this year as well. So, how do you sustain this big pile of debt? So, one thing is you have to look at options beyond your normal issuance pattern. You can't just rely on, say, backing of regional sovereigns or thinking about, can I just issue more dollar debt? That's not sustainable path. The things which I believe many of these issuers should think about is ESG issuance, green bond issuance, sukuks. I'm surprised that Oman and Bahrain, who need so much of debt issuance, do not issue sukuks by the government. The sovereign issuances are not sukuks. It's so surprising that only 3.3% of the debt, or say of the total debt in MB, is sukuk from Middle East issuers, while this is the market where they should be tapping. So sustainability is an issue, because ultimately, if you think of what crises have taught us from Asian financial crisis, too much of dollar debt is never good for anyone. You have to think beyond the existing debt issuance and think what is a sustainable path forward.
Mm-hmm. Do you think there is room in portfolios for project finance bonds again, which we haven't seen too many of, in spite of the infrastructure kind of requirements that there are in the region? We've also not seen too many asset backed securitizations from this part of the world either. I know there were a few that were attempted, but the feedback I had at that point was the pockets of kind of appetite for those for Middle Eastern ABS was very limited in general. So, Andrew, please, feel free to add in, or Abhishek, I'd love to hear your views on this.
I would say, go on.
I was going to say, Middle Eastern ABS, definitely not my area of expertise. I'll definitely defer to you on that, and I can chip in afterwards on some of the ESG topics.
So what I would say is that traditional means of debt issuance isn't going to be, shouldn't be just the way forward for Middle Eastern issuers, because the market is moving beyond that. You need to find pockets of demand, and the pockets of demands are from these niche debt buyers. So either it's project finance or asset-backed securities or sukuks or green bonds. All of these, or local currency bonds, for example, all of these are the niche demand areas which the governments and issuers need to tap in. The more you tap, the better it is, because you have diversified your risk away. And for buyers, it's good, because then you don't have just one massive pile of debt as one issuance. It's all spread out into different buckets, into different proceeds, and it helps their standing in eyes of the buyer.
Can I just add one thing about the green issuance out of MENA in general? So from what we're seeing is that 2020 was kind of a turning point for green issuance out of the Middle East in general. About $28 billion worth of green bond issuance was issued from 2007 to 2020. But in just 2020, just out of the Middle East and Egypt, we've seen about $4.5 billion of issuance done in green bonds. So the Middle East didn't issue as much as China and Asia and South Asia, but 2020, in our view, is kind of a turning point in that perspective. And a lot of companies are talking about ESG and how we approach that. And again, you're looking for a perspective from the buy side, and governance and social issues have long been embedded in a lot of these emerging market debt shops for quite some time. But environmental is becoming a lot more important. It used to be pretty difficult to link environmental issues with the sovereign bond performance or corporate bond performance. as more and more investment banks and investment funds are paying more attention to environmental issues, the more premium it is now required on bonds that issued by companies in polluting industries. So there are some investment banks, for example, that just will not underwrite coal mines or generators for coals. It is harder for those companies to access the market for themselves. But if you buy the bonds, then it'll be difficult for you to sell the bonds when you're trying to find some liquidity in the secondary market. Vedanta is a mining company based in India, and it is forced now to pay double yields. And names like NTPC, which is now essentially blocked out of the issuing. It's a big coal producer, again, power generator. They burn coal. It's a large national electricity company. They have issued domestically in India, but it's harder to access market globally. And so that something to think about, because bonds in the ones that are coming up with an ESG protocol, kind of the ESG protocol compared to non-ESG, they do find better pricing in the secondary market a lot as well. So there's a lot of money chasing these as bonds, and as some of my colleagues here have mentioned, Europe has been on top of it. They've been doing that for years, really, at this point. US is catching up. I'm seeing a lot of interest from Asia in green bond and ESG kind of issuers in particular. So it is definitely catching up. But there are some deals that are coming to the market, like Ultratech, which is the largest cement company in India, and came in with a sustainability bond with a lot of hype about CO2 targets, renewable generation, water recycling, waste management. The bond has pretty low greenhouse emission targets. And they've put in about 22% reduction by 2030, and there was a coupon step up if they didn't achieve those targets, and it would only go into effect into the final year. And the bond can actually be called early. There's a call date before that. So unless we see these kind of issues, which are really trying to target the green bond ESG audience, but not really a representative of what that means, I think this is definitely the market that we should look into expanding more.
If I may, I absolutely agree with what Katrina just mentioned, in the sense that ESG is becoming more of a focus now. I just a bit nuance on Vedanta. I think the yield doubled because of the fundamentals of the company that were very controversial. I just want to add one thing on what Abhishek said with regards to the sukuks. The sukuk market has been a significantly growing market from a demand perspective, but if we look at the issuance, for example, this year, MENA issuance reached 17.6 billion in conventional, and only 1.75 or slightly below 2 billion in sukuks. We believe that a diversification in investor base is definitely crucial, be it ESG, be it currency, be it in sukuk, and especially that you have a natural demand, you have the natural investor in demand for sukuks in the region. But we haven't been seeing sukuk issuance because we think from the possible reason is that the stricter implementation in the UAE, so the UAE central bank placed what is called as the higher standard authority, which is pre-approve sukuk issuance for UAE banks, which remain the highest player in the Islamic market. So the central bank should pre-approve those sukuks for the banks to invest in them. So that's one hurdle. And the other hurdle we think that is slowing down sukuk issuance is the IOFI standard dealing with the tangibility ratio. So in a mudaraba structure, if this is completely implemented, it makes a mudaraba structure completely out of it becomes prohibitive in terms of cost. So we think these are the factors that are causing sukuk to be less attractive for issuers, but definitely on a demand perspective, demand is significantly growing. Knowing that the top 6 funds in the region, the AUM has grown 50% in 1 year. So demand is there and supply is becoming lower and lower.
Thank you for that, Zen. I was going to come to the Sukuk query. Maybe we just, let Andrew finish off. He had a few points to make on the ESG aspect as well.
I can't rival the detail of my fellow panelists, but speaking very broadly, absolutely ESG investing is the future in terms of where a significant amount of demand is going to come from that avenue. So it's definitely, I would completely agree with the, issuers need to be thinking very carefully about how they can access that market because the demand is significant. We do see, as was mentioned, we do see premiums for green bonds in the market. So right now, that demand supply imbalance is in favor of the issuers. So it's definitely a good funding option. There's definitely going to be only increased demand going forwards. And certainly, it's interesting. There's been relatively little of it so far. And when we look at the opportunities that we've seen, it is a bit few and far between. So it's definitely an area where, certainly decarbonisation, the environmental side of things, there's a lot of opportunity there for some of these issuers to kind of tap into that demand. And then just like a very brief point, I thought the panelists' point on Turkey were excellently made. I think from our perspective, the biggest challenge for Turkey, as pointed out, was the sustainability of any sort of reform momentum or positive steps taken. You have to look at a chart of the Turkish lira to kind of see this sort of step up along the last few years. And I think for us, we're very conscious that the statements and the kind of intentions of Erdogan versus the perhaps like the actions of replacing the central bank governors, etc. It all feels very temporary to us, and that concerns us. So yeah, we're pretty cautious on Turkey at this point in time, but we're certainly not as in the weeds as some of the people on this call are. But I think the ESG side of things, 100%, it is a massive pool of capital that is only growing, and the demand is going to keep on picking up.
On ESG, as you rightly mentioned, you're today seeing investors, willing to pay a premium for that. I think question one would be, how sustainable is that? And you also have a related query with regards to, for most of the ESG issuances we've seen from the region, the pure ESG investors have been less than 20%, in many cases actually less than 5%, right? So like to hear your views on on that as well. Are you expecting that a pure ESG play for Middle Eastern credit to increase, or are you still seeing that in the recent future to be more of a European play? Because it's a very different dynamic for European issuers than it is for Middle Eastern issuers in that space.
Absolutely. I think the first thing I'd say is just like how we're still very much in the infancy of this entire sort of, I don't know quite how to describe it, but let's call it a investment genre or something like that. The reality is standards are still being finalised. So in Europe, we've got the EU taxonomy, which is a very demanding and very sort of detailed sort of specification of what qualifies as sort of essentially green, what qualifies green funds in the future. But it's incredibly challenging, and issuers are still racing to catch up with the requirements. So I think like we're very early in this movement, if you will. I think there's going to be a lot of growing up to do, and I think one of the panelists mentioned, some of these ESG deals, they might be labelled as ESG compliant, but they're the details of them don't exactly smack of like a great deal of intent as well. So I think I think we're very early in this trend. So I would fully expect the markets to become deeper. The degree to which the pricing as it exists now is sustainable, I think it's indicative of the fact that we are early and yet the demand has jumped up. Just speaking with our clients, at the end of the day, a lot of these institutional investors in Europe are mandated now to have ESG style policies in place, and so they push that on to us as investors. And obviously, we're busy trying to find the best deals out there. But a lot of the times, to a certain degree, there is a degree of to which the universe of assets that comply are relatively small, and as it grows, there's clearly deals there which perhaps when we look at things from a fundamental perspective, we're often not that taken by what we find in the ESG space at this point in time. But I expect that will change, and as supply picks up, obviously the differentiation between what I describe as good deals and bad deals will become clearer, I think.
Thank you, Andrew. I'd like to touch upon the Sukuk market as well a bit more, Zaina. Thank you for your thoughts earlier. I have the same views. You're right. There has been a very strong increase in AUMs for Sharia compliant assets. We're also seeing a very strong increase in liquidity at Islamic bank treasuries who also invest in these assets, right? Within the backdrop of lower supply due to the reasons that you've mentioned, how do you see value in the Sukuk space at this point in time?
As you rightly mentioned, it's been a demand-driven market, even though it's not an infant market. And it's increasingly a demand-driven market because, as you mentioned, supply is just not there. The more supply is not there, the more the market, it's counterproductive for the market, right? Because basically, even if you find the sukuk being very tight or not attractive anymore, you just can't sell it because you simply cannot replace it. So as long as we keep having lower supply and as much as the demand versus the supply imbalance grows bigger, you basically, at some point, if this is sustained, you would simply kill the market because bonds will simply stop moving hands because you cannot stay on cash and you don't have free supply. We don't think that this is going to be sustainable. We think that this is going to be reversed. And as we're hearing, I'm sure you would know better, but as we're hearing from DCM, that the pipeline is there and it's going to be picking up. The good thing is that the sukuk players are no longer, it used to be before dominated by only the bank treasury, which mainly are 5 to 7 years player, high grade, and don't really look at any other structure. Given how the AUM grew and given the diversification now of the investor base, this gives us a bit of comfort that more corporates can come to market. We started seeing this last year with a new structure. For example, you had the DP World PERP, which shows a unique structure in the sukuk space. So we are hoping that this direction is going to reverse, in the sense that, this direction is going to continue and the lack of supply is going to reverse pretty soon for the markets to remain sustainable.
I'll just add one thing about sukuk from the buy-side perspective also, because sukuk is now included in the corporate debt indices and the sovereign debt indices. So if you have portfolios that are managed against these indices, you kind of have to pay considerable attention to the issuers there. But at the end of the day, it is a bit of an untested instrument in the case of default. And so at MFS, we've certainly bought sukuk in the past when they were highly rated. And we find that sukuk right now benefits significantly from the local bid. They tend to trade pretty rich relative to the other conventional bonds. Local liquidity supports them quite a bit. We do get involved, but it's not something that we do very often or just kind of step into it unless there is a big issuance in the benchmarks. Just something to think about.
So just to add one thing in terms of default, we've recently had a few sukuk defaults. We've had Dynagas 2 years ago. We've had NMC, but NMC is a completely different and separate case because it's a fraud case. But we've had Garuda and we've had Dana. I agree, it's pretty still untapped, but those two experiences turned out to be positive for investor at the end of the day. So except for NMC, again, this is a completely different ballgame.
Thank you, Zaino. And Abhishek, you briefly mentioned this when you spoke earlier with regards to, and Andrew did as well, with regards to local currency debt markets. we're obviously seeing much more activity from the region, Saudi, Oman, and UAE as well now. What are your key considerations for investing in local currency markets?
Yeah, absolutely. I mean, it's an amazing development and one which was long due. I mean, if you think of how Asian financial crisis developed, it's because of too much reliance on external debt. And if something is to be learned from that is that you need to develop a domestic bond market. So amazing. This is an amazing development. For the first time ever, it's a big step in UAE that the central bank as a federal central bank and not the sovereigns, individual sovereigns, issued debt. It was only a T-bill, or these are only T-bills, but still is a big step forward in that this is a local debt issuance from the UAE central bank.
Mm-hmm.
Obviously, UAE is way behind the curve. Saudi is the front runner in this space. I mean, of the about 228 billion of local currency debt from the 6 GCC countries, Saudi has about 132 billion. So it's pretty much the biggest player in this space. And if you see where they are way ahead, but still a long way to go. For example, they started issuing 5 years back, and they were issuing a lot of bonds. They had too many bonds. Instead of tapping bonds and making them more liquid, they were issuing just too many bonds. So for last year, they only issued 8 bonds, and they tapped most of the bonds, which is a positive step. But if you see where the leader in EM space is, like South Africa, it hasn't issued a new bond in last 6 years. The last bond it issued was in 2015. It has been tapping its existing bonds, making them more liquid since then, and which is what actually needs to be done. So why would international investors come into the bond market, in this bond market? Because there's a peg, so there should be no difference between dollar debt and local currency debt. You would want a slightly higher yield pickup, but you need to have liquidity. And this is where work needs to be done to create and improve liquidity, to make these markets deep and improve the size that you can trade in these. But definitely, it's a long journey, one which I think, in my view, is the way forward. Just cutting down on dollar debt issuance, thinking about different ways, sukuks, green bonds, local currency debt, project finance, any other debt issuance which is not the conventional. Anything which is non-conventional, in my view, is what the issuers in this region should focus on, because there is demand. It hasn't been tapped yet.
Thank you for that, Abhishek. I guess we've reached the end of a panel session. If there are any more questions from any of the attendees, please bring them in. I have one from my side. It's not something we can measure, but it's more, if we were to look into, a crystal ball, and I'd like to have each panelist answer this, where do you see the 10-year US Treasury in Q4 of 2021?
Okay, I'll start.
Yeah.
I mean, yes, we all saw that treasuries are going to be higher. We did not expect the move to happen this fast. But I don't think that we're going to have another significant leg higher from here in terms of yield. So I think we're going to remain range bound. So if I were to answer where we're going to be in Q4 this year, I would say we're going to be roughly where we are now in a range bound. Obviously, we don't expect any talks on tapering anytime soon. And if inflation surprises to the upside, given the fiscal stimulus and the successful vaccine rollout and all where it is, I think that the Fed will shift to becoming even more dovish, emphasizing more on the comfort of letting inflation overshoot for some time. And if really need be and steepening is to continue, I think the Fed would intervene in the curve, but I don't think this is going to happen anytime soon.
I mean, at the expense of kind of parroting a thing, I mean, coming into this year, we had yields ending the year at 145, and we're within sort of a basis point and a half of that right now. Our upside was more sort of the 170 to 180 level, and I guess with the fact that stimulus in the US is going to be bigger than we'd anticipated, we'd probably push it up towards those sorts of levels. So I think there's room for the yield to run a little bit higher. But the reality is as well, like given the kind of how we expect the growth dynamic and the inflation dynamic to evolve through the year, I think we could have a fairly big range in Treasury. So I wouldn't meaningfully shift above where we are now, and certainly like the forwards are already pricing that sort of outcome. And I do think, inflation, the next 3 months is going to be fascinating for markets and for central bankers in terms of watching their reaction function, because we know we're going to get probably double-digit quarterly growth. We're also going to get very high inflation just purely as a result of the base effects and the supply chain bottlenecks, all of which will pass. And if you look at some of the core measures, trim mean, CPI, for example, none of them show any sign of strength. So I think we've learned the lessons of previous crises where early tightening was occurred and probably shouldn't have done. But it's only going to be interesting. But I think in a way, a point estimate on Treasuries this year is probably almost the wrong way to look about it. Look about it unless you are willing to turn off your Bloomberg screen and go away for the next 9 months.
So one thing I would add on that is we're kind of similar in terms of MFS rate expectations. So we think we're going to be at about 1 3/4 by the end of the year, but the range is 1.4 to 1.9 kind of thing, and that is as the world enters, of course, this mini boom. A lot of the people are worried about, and as we just heard about the inflation, about the tantrum without the taper in the markets in general. One thing I would say about the Biden's package that everybody's talking about, I mean, it is a big package, but it consists of several parts. 40% of the Biden's package, right? It's about $750 billion. It's used to aid, mass vaccinations and, fund state and local governments. This part of the package will not produce much of the boost to GDP. There is going to be additional funding to local governments that could reduce layoffs. So of course, that's positive. But in general, the 40% of the package really is not going to go into that big growth boom in US. About $1 trillion out of that package, which is slightly above 50%, that will be used as a kind of direct income subsidies for households and rebate checks and child tax credits and increase in unemployment benefits. And then there is also a very small kind of 8% of the overall bill, $150 billion, that will be for financial aid for vulnerable businesses. So what I'm trying to say is that income subsidies, which is the majority of this bill, are totally different from public sector investment. Income subsidies are similar to tax cuts, where public sector investments are directly responsible for increase in GDP. So here we think that the businesses and consumers will almost always try to save most of that tax cut rather than spend it. The case in point you've seen last year in 2020 when we had this first $3 trillion package that was passed in March of 2020, and that produced very limited impact in terms of the boosting GDP growth. And consumers at that point basically not only saved most of those income subsidies, but they saved even more than they received. So from that perspective, it is a very interesting point to talk about, but we do not conform to the fact that there is going to be an increase in inflation and a really significant growth in US. And so as a result, we think the Treasury rates will be higher, but then we should see the reduction in the spreads in the emerging market debt market overall with a positive total return by the end of the year.
Abhishek, we received a query from one of the attendees as well with regards to relative value for GCC bank sub-debt, both AT1 and Tier 2. There are very few Tier 2s being issued, but AT1 specifically, versus what you see for global peers.
Yeah, so subordinate debt in Middle East is not widely tracked. That's the problem. So from a relative perspective, they do offer attractive value, but The problem is these are not widely in any of our major indices. So if you want to invest it, first of all, the investor base is limited. The second is if you do want to buy it, it has to be an out of index position. And the flip side of that is the moment there is a sell-off, the first thing you do is sell your out of index positions. So there is there's opportunity, there's a good value in them, but you have to bear in mind that you will have volatility in these as and when there is a sell-off. These will be the ones which will get punished quickly. So yes, we do buy them, but again, the places where we can buy them are extremely limited.
And Zaina, perhaps a query for you, again, coming from one of the attendees with regards to Egypt. I think their currency has been relatively stable to the dollar, and therefore there's been a lot of interest in the US dollar T-bills that they issue. What are your views? Do you expect that volume to continue, given they've also had access, obviously, to long-term US dollar debt in the capital market space as well?
Yeah, Egypt has been the sweet spot for emerging market portfolio managers for some time now. They had huge difficulties last year, hit from tourism, COVID, and remittances at the same time. This has reversed from portfolio inflows, IMF support. We do like Egypt as a story, and we still like Egypt as a story, even though we think that in the short to medium term, there are significant fundamental hurdles. So the inflows we think are going to reverse, but we think that those will partially be outweighed by reopening in tourism and remittances. So all in all, we're positive on Egypt, and we still like the story. We also think that Egypt will tap the market in the sukuk space. They had passed the law Q4 last year, and we think they will tap the market, which also diversifies their source of funding, and we think that it can also reduce their cost of debt.
Thank you, Zaina. I believe that brings us to the end of our panel session today. It's sharp 5 p.m. I'd like to thank all the panelists for your views, and also to Michael and GBSA for organizing this event today. Over to you, Michael.
Thank you very much, Hitesh. Thanks as well to Andy, Abhishek, Katrina, and Zaina for your great insights today. And thanks to our audience for staying with us throughout. Please stay safe and keep an eye out for future events, which we'll be announcing soon. Thank you, everyone.
Thank you, everyone.
Thank you, everyone. Have a good evening.
Thank you.
Bye.
Thank you.
Bye.